Hi everyone, I'm Susan Wornick, and welcome back to one of our occasional ongoing discussions about, well, we call it Money Talks, because it really does, and we need to talk about it, and we need to get information. And who better to get that information from than two dear friends of mine and experts in their field, Mike Finer and Gary Coon, who are the principals at Finer Wealth Management, and it's lovely as always to be here with you guys. I always feel better about my life when I'm with you. I feel more secure. And when you're laughing, Gary, that's when I really like it. You're smiling, things got to be pretty good. So Gary, what do you think?
Yeah, it's interesting. Presidential election years are very interesting historically, as are presidential terms. There's actually a definite pattern over time to what happens to the stock market on average over time and what happens in a four-year presidential term. Typically, the third and fourth years of a presidential term are the strongest in the stock market, and the second and first year are not quite as strong historically. And if you look back, particularly last year and the year before, it played out with that pattern. Last year was 2019 was a very strong year in the stock market, and 2 years ago it was down a little bit. Now we're into a big presidential year, and historically, actually going back almost 100 years to 1928, there have only been 4 election years where the stock market has been down, which is, I think, an amazing a fact. And those tended to be in years where you had the Great Depression, you had the beginning phases of World War II, and you had the Great Recession, just as examples. And so those are very unusual, historically speaking, circumstances. And so that kind of, not that that's the only thing that you would look at when you're thinking about your investments and what the economy might be like, and particularly the stock market might be like in the 2020 election year. But, we do look at history as well as what's happening internally in the economy in the particular year that we're in. So,
yeah, when making predictions, that's the best thing to do is look at the information you have from before.
Now, certainly, and as Gary mentioned, the first 2 years of a presidential cycle have about half the historical return than the third and fourth years do. So it's literally double the stock market return in the third and fourth years of presidential cycles than the first 2 years, which is very important. And this is held for a lot of reasons throughout history. And in this particular cycle, it's really playing out almost traditionally, where the first year was it was actually a decent return, and that was an unusual occasion. As Gary mentioned, year 2 was down, year 3 was way up, and year 4 would expect to be a fairly decent return in the stock market, which is really important at this point because a lot of people have been taking money off the table in this stock market because they believe that the market has just gone on too long. It just is a natural tendency. In fact, net outflows have come out of mutual funds by individuals over the last year or two. But the cycle would dictate that we're going to have a very positive year, so it's sort of the wrong thing to do for people, and that's why we wanted to emphasize what the cycle means, and that the cycle does typically hold true over time.
The thing that's fascinating, though, that really is fascinating when you look and say this has, been happening for years and years. But then it's complicated, at least for me, who does not know the stock market that well. Perhaps you guys know that. But I think a lot of people may be like me, and there's the influence of daily news. And people say, well, what's happening with China? Well, then you hear the stock market is off, and then what's going on with Iraq and OPEC, and does that really play into this to any degree, or not really in the long run?
I think it certainly does, and I think that the fact that there is a presidential election in year 1 plays into people's psyches in the first place, and that is uncertainty. So everything that you talked about relates to the stock market principle of uncertainty. When things are uncertain, it tends to affect the stock market in the short run, but there are different types of uncertainty. So in this year, the type of uncertainty that we're dealing with is who is going to be the new president. That's fairly substantial. Every year there's uncertainty. So 3 years ago it may have been that we had issues with China. Then we may have had issues with Iran. Then we had issues in South America. Very, geopolitical issues. Interest rates at the end of last year were going up. Now they're going down. So there are always those factors that play into it. But there are the factors in the cycle, the bigger cycle, the 4-year cycle of how a president gets elected, and making policy changes in years 1 and 2, and then being more steady in years 3 and 4, so he can get reelected, or maybe she.
It's fascinating to me, though, because everybody wants you to have a crystal ball.
Well, I think you do sort of need a crystal ball to help guide people to understand that, yeah, the tendency is we've had a stock market that's gone on for 10 years. So people's tendency is it can't continue. So try to provide fact-based situations that illustrate why it can go on and that we don't have to be hamstrung or have a straitjacket from the past so that people can get, good rates of return.
If you looked at the beginning of last year, coming off a negative year where some people were saying that we might have a recession just right around the corner, where the Federal Reserve was more in a tightening mode than they are now. And if you said that the president was going to be impeached, and that for a good part of the year we would be sort of arguing in the court of public opinion with the second biggest economy, China, you would have said, boy, 2019 is not going to be a very good year, and you might have really sort of pulled back. But yet there are other factors at play, things like, are companies still making money? Are people working? That also factor in. So you need to not only look at the historical patterns, but you also need to look at sort of the shorter term turmoil and the underlying aspects of what's actually happening in the economy. And then you can sort of make a more informed, prediction.
Yeah, I know you guys have always said to me, the stock market is not for the weak of heart, and you can't just have a knee-jerk reaction to something that happened today. And that, I know, has always been your advice. It is a long haul.
Yeah, and to your point, it certainly, the news affects today, maybe a week, possibly a month, even a quarter. But looking back over a 100-year cycle, there are definitely, patterns as to how things work in the macroeconomy and how presidents get elected and how things happen. And the interesting thing about the cycle is that it doesn't matter if it's a Republican or a Democrat. This holds true regardless of who got elected. Has nothing to do with politics per se.
But Mike, what do you mean how the president got elected? What do you mean? Like who donated, or what do you mean?
Maybe not how, but a lot of people will say, Republicans tend to be better for the economy, right? That's just some sort of anecdotal opinion, but that's not the case in the stock market. Whether it's been a Democrat being elected or reelected in the 4th year, or a Republican, the 4th year of a presidential cycle during the reelection tends to be good. And in particular, it is a volatile time. The 4th year, that's one thing I will point out, that when we say how they get elected, there's a lot of turmoil during the election year. We don't know who is going to be in the election, who the candidate is from one party. There's going to be a lot of attacks back and forth. So the 2nd and 3rd quarters tend to be negative and very volatile. It's the 4th quarter, once the president is elected, regardless of if it's Democrat or Republican, November 3rd, 4th, whatever that date is for the election. After that, those next 2 months, a lot of the gain tends to happen once that occurs, regardless of who it is.
So I hear you saying put your money into vodka. Or is that just me?
Well, yeah.
Well, but I make a joke, but it leads me to a serious question, though. I mean, which is, so do you tell people to move your money around to different stocks rather than just take it out, depending on where we are in the cycle?
Well, everyone has a different circumstance, typically. So depending on someone's circumstance, we may say, if we're going to deploy money, we might decide to maybe weigh it toward the end of the year, because we may have some volatility during the middle of the year. And we also take a look at different industries that may tend to be more stable during a presidential election cycle too. So, yeah, there is some, truth to that. The major thing, though, is we try to encourage people not to do the knee-jerk reaction, which is not put money to work at all, or to withdraw money, which is what's been happening, actually. People have been withdrawing money from the market because it's peaking. And we talked about this last year with the market, as Gary said, at the end of last year, and it's hard to believe, last December the market was crashing, it was cratering because of China. Mm-hmm. Higher interest rates, a lot of other things, so people were withdrawing money. By January, it bottomed, and we had an excellent year. So the people who had taken money out, it was a mistake. So to your point of the political news was overridden by the strong cycle, which brought things back. And we encourage people to say, take a look at the cycle. We expect have a strong or decent 2020 as a result, but the probably first year to the end of the first year of the cycle of the new president, whether it's the current president or next president, tends to weaken. So we have another year and a half probably left according to the cycle.
I'm Susan Wornick, and I am talking today, as we love to do all the time, with Gary Coon and Michael Finer from Finer Wealth Management. It's a segment of good, solid financial information that we call Money Talks, because it just really does. So I hear what you're saying about in the year 2020, it's just part of the cycle, and it's an election year. But what is your advice to the people who are watching today who've been in the market for a while and who've had a lot of volatility? And I always bring up GE as one example because there's so many people from around here who were heavily invested in GE, saw it, I hope, bottom out, and now it's building back up. What's your advice?
Well, one consideration is what we look at in portfolios is, it could be GE, it could be Boeing, it could be any number of companies that you never know when there may be some kind of an event or a legal action or some kind of a change in an industry in terms of regulation. So what we try to do is we try not to have an over-concentration in any one particular company. You hear about diversification. That's one aspect of diversification, is not having all your money not only in one industry, but one actual company. Because if you have a well-diversified portfolio, if these sort of in some cases unpredictable, other cases maybe a little bit more predictable, but in cases where there's an unpredictable circumstance, you don't want to have that have an impact on your overall portfolio that's outsized, and you can deal with some of that through diversification. I don't know if you had something to...
Which is why you need a good advisor.
Well, in an ideal world, and that's we obviously encourage people, but to your point, there are many people who may have built up, a disproportionate share in GE, or, in the old days it was Polaroid, if you're in Massachusetts, for companies where they got stock or got deals on stock because of the 401k plans or other things. So in those cases, yeah, we do encourage people as they get closer to, some sort of event like retirement to try to diversify or sell into it. But GE is a good example of, what 2020 may look like. And, GE 20 years ago was at, say, closer to $60 a share, where now it's in the teens, which is a big difference, right? So not only have you not appreciated in 20 years if you own, just say that stock, but if you happen just to own that stock at this point, what do you do?
Pray.
That's,
Cross your fingers.
Probably,
I mean,
yeah.
I don't mean to make light of it, because I know people
No,
who are very poorly, adversely affected.
No, it's been tough for people who own a concentration of that stock in particular and other stocks.
I think the other thing is you need to continuously look at these companies in terms of their management. We always talk about that we really want to make sure that we are investing in companies that have strong management, and that needs to be looked at fresh continuously. because companies do change their management over time. We typically don't have all of our eggs not only in one company as an example, but also in a variety of industries, because you're going to hear over the election year that certain industries are going to be kind of have the target on them from a political standpoint, and after the election there may be certain industries that may be favored by depending upon who wins the presidency. And others that may be considered maybe a little bit more at risk in terms of regulation and the legal structure. So you kind of have to look at all of those things. And but we're also not only looking at this particular calendar year, but also looking longer term, because you want to kind of have that 2-point view in terms of your clients, because...
What do you mean the 2 point?
Well, you need to kind of have your eye on the short term and the long term, I guess, at the same time. Because there's sort of these longer term trends that are very strong trends. We have the longevity economy where people are living older, and that has ramifications for what kinds of companies serve that particular growing population. You have a trend in technology where you have artificial intelligence and robotics. You hear about self-driving cars and things like that. So there's sort of these trends that we want to make sure that there are companies that maybe do a little bit better in one year or another, but there are also industries and companies within those industries that we don't want to miss those either. And those maybe take a little bit longer to play out, and so that's also part of diversification. And it's kind of nice to have at least one eye on the future, and maybe those short-term, political ads that you're seeing that that are very frustrating and cause a lot of angst. It kind of helps with that, keeping the longer view.
So, what is the advice that you give to people as we're now into 2020 and we are in an election year and we are seeing daily news events affect the markets?
Well, we try to tell people to, and I know it's hard to do, but with what we recommend is trying to block out some of the noise when it comes to investments. So look at the longer range, view of companies, their profitability, the overall economy's growth, low unemployment, interest rates. Focus on that, because no matter how you look at the news, there's always been issues in the news. In the 1970s, it was Richard Nixon being impeached. In the 1990s, it was Bill Clinton being impeached. In 2020, it'll be Donald Trump has been impeached. But the 90s were an excellent time for the stock market, regardless of that event. We have tariffs that have now come on. We have a war through proxies in Iran in many ways. So tell people, throughout history, we always have things that would make you worry. And some of those things are worrisome, and they can affect the stock market in the short run and particular companies. But over time, we're actually relying on great companies growing over time and taking advantage of new technologies and other things that will help grow profits and wealth.
That sounds reassuring. I mean, it's like you always say, just gut it out and just be calm. It's not that easy, though, for some of us.
Well, it's very, very hard because, it's not as simple as us saying, hey, stay the course, because people have goals and wants and needs and times they have to withdraw money.
And expectations and
Sure.
hope, And
Yeah, and is your money going to last forever? And what happens if there's an event, as we said in 2008, the market was down over 30% very quickly, and that's very troublesome. People now would say, well, what happens if the market, went down 20% quickly? So that's not a good feeling. It's not a good feeling when the market goes down badly. So it's a delicate balance, but most importantly, generally, it's good to maintain the course. But also, we take a look at it and say, hey, if you have something that you have to spend in the next year or two, we may not have that invested in the market. We may put that aside in bonds or cash, so that if we have a volatile time,
You're
you're not
safe.
forced to sell. Yes, you're not forced to sell your stocks because you have to pay for something. So you try to prepare, you have to prepare for that to have an emergency fund, or we always like to think of it as at least 1 to 2 years of pretty liquid investments, because most volatility in the stock market has never lasted more than 2 years in a row, even during the Great Depression. So if you can gut it out for 2 years during a down market, your stocks, if you have quality companies or your funds, will generally recover. But if you can't, you're selling into a bad market. That's the ultimate, death wish.
The other reason to keep some powder dry is we like to be able to take
Powder
it,
dry,
yeah,
I like that expression.
is to take advantage of opportunities, because with that volatility, there can, if you have a dip in the market, that's the time to maybe buy low, as you hear. So
Okay, so what
Yeah,
are some of
yeah.
those opportunities? Let's give people a couple of ideas in our closing moments.
Well, I think, we may not talk about individual stocks per se. I think, the themes that we're focusing on for 2020 are high technology. And, those are the usual stocks like, the FANGs, Facebook, Apple, Netflix, Google. They generally would be the type of companies, well, we're not giving individual recommendations, that tend to benefit from this part of the cycle. And then industrial companies tend to benefit from this part of the cycle as well, that make machinery and make equipment and do things in this time of the year. So, and we're looking at some of the industries that tend maybe not to do so well in presidential cycles. The number one that tends to get beaten up the most, is pharmaceuticals. They're the poster child for everyone that, during the political cycle. Although they've done well over the 4 years, people would not have expected that 4 years ago from all of the talk.
Right.
And that relates to the longevity trend, and that people need products, and that the group that needs the products is a growing market. That tends to be,
Right.
There may be other counter forces at play, but there's also sort of the wind at the back.
Well, and I know that I just want to share some advice that you both individually and as a company have given me, which has worked, that if you see yourself using something, if you see yourself intrigued by something, you're probably not the only person in the world, and it might be worth looking at it as a good investment, because if you like it, then chances are others do too. And I probably should, for the full disclosure, mention that I was also the person who said, shopping online, that's never going to work. People want to touch stuff. So, ixay one on that famous Susan Wornick prediction. But I think that's good advice, right? That if it's something that you connect to and you feel good about it, then it's important to use that word, go with your gut again.
No question. And, we sort of got that. That was a great book by Peter Lynch, the great Fidelity Magellan, manager, who talked about that as well. And even though you may not have been the first online, you've actually had some good ideas. I won't say which ones, but you've had some good ideas for the actual physical retail space. And we will say this because you may be in the retail space shopping more than most, I'm guessing, and you've had...
I do my part.
You do your part, and you've had a good eye for that, and it speaks to the retail space has been difficult, but you've identified a few niche companies that actually have performed really well in the retail space when the overall space hasn't, which is also a skill and something that people can do. Even though Ford might not be doing well, Tesla may be doing great. And why is that? You can look at that. So certain retail companies, most aren't doing well, physical retailers, but there are a few that are doing great. So that's excellent advice. It's probably some of the best advice. I would suspect that most of the stocks that are doing well for our company we're using the products, for sure.
There you go, to our point. Thank you
Yes.
both, not only personally for all the great advice you've given me, but I know that our audience and everybody who has watched Money Talks has learned a great deal. So Mike Finer, Gary Coon,
Thank you,
thank
Susan.
you.
Thank
And
you,
thanks for
Susan.
watching.